Let's cut through the noise. Something massive is brewing in the silver market, and if you're holding physical silver, paper contracts, or mining stocks, what happens in the next few weeks could determine whether you walk away with serious gains or get absolutely crushed. Here's what you need to know. The Chinese markets are about to go dark for 9 days. Starting this Sunday, China shuts down for Chinese New Year. 9 full days where the Shanghai Futures Exchange, the world's second largest silver trading platform, goes completely silent. And during that blackout window, the US banks and COMEX have a golden opportunity to do exactly what they've been itching to do for months: engineer a violent price takedown in silver. Why now? Because without China watching, without Shanghai's counter-pressure, without the world's largest physical silver holders able to respond in real time, COMEX can short attack the market with impunity. But here's the twist. China knows this is coming. They've been preparing. They've been tightening the noose around Western silver supply for weeks. And the date you absolutely need to circle on your calendar is February 27th, 2026. First notice day for March futures contracts. That's when the music might stop, when the paper games collide with physical reality, and when we find out if COMEX has enough actual metal to survive. This isn't conspiracy theory. This is documented fact. And by the end of this video, you're going to understand exactly what's happening, why it's happening now, and what both outcomes could mean for your money. Let's get into it. To understand what's really going on, you need to see this for what it is: a financial war between two superpowers fighting over one of the most strategically important metals on Earth. On one side, you have China. They control somewhere between 60 and 70% of the world's refined silver supply. They're the dominant physical holder. They own the metal, and they want the price to go higher, because higher prices mean their stockpiles become more valuable. Their industrial advantage strengthens, and their leverage over Western economies grows. On the other side, you have the US banks and COMEX, the New York-based commodities exchange where silver futures are traded. These institutions are massively short silver. They've sold enormous quantities of paper contracts, promises to deliver silver they may not actually have. And they desperately need the price to go down, because if silver runs higher, those short positions could implode and trigger margin calls, forced buybacks, and catastrophic losses. So this isn't just about price charts. This is about two opposing forces locked in a high-stakes game of financial chicken. China wants the squeeze. COMEX wants the escape hatch. And the next few weeks will reveal who blinks first. The price you see on your screen right now, it's not a reflection of supply and demand anymore. It's a reflection of this war. Now, if you're new to silver, you might be wondering, can they really manipulate the price of an entire commodity? Short answer, yes, because they've done it before. Let me take you back to 1980. Two brothers, Nelson Bunker Hunt and William Herbert Hunt, tried to corner the silver market. They accumulated massive physical positions, driving the price from around $6 an ounce all the way up to $50 in a matter of months. And what happened? The powers that be panicked. The COMEX exchange literally changed the rules mid-game. They introduced something called Silver Rule Number 7, a regulation that banned new long positions and only allowed liquidation. In other words, you could sell, but you couldn't buy. The Hunt brothers were crushed. The price collapsed. And the message was clear: if you challenge the system's control over silver, the system will rewrite the rules to destroy you. Fast forward to today, and we're seeing echoes of that same playbook. Margin requirements getting hiked to force liquidation, inventory rules being adjusted, trading restrictions appearing out of nowhere. The game hasn't changed, only the players have. But here's the difference this time. China isn't the Hunt brothers. China is a sovereign superpower with its own exchange, its own refineries, its own strategic agenda. They can't be margin called into submission. They can't be crushed by a rule change in New York. And that's why this situation is so much more explosive than 1980 ever was. So why does China care so much about silver right now? Why are they making these aggressive moves to control supply and price? 3 words: industrial demand explosion. China isn't just hoarding silver for fun. They're installing 160 gigawatts of solar capacity this year alone. Every single solar panel requires silver for its conductive pathways. The more panels they build, the more silver they consume, and they can't afford for that silver to become prohibitively expensive or unavailable. At the same time, China is mass-producing electric vehicles, millions of them, and every EV uses significantly more silver than a traditional combustion engine, primarily in electrical contacts, circuit boards, and battery management systems. So China has a dual motive. They need affordable silver for their industrial machine, but they also recognize that if they can control the global supply, they hold enormous leverage over the West. If Western nations want to build their own solar infrastructure, their own EV fleets, their own tech supply chains, they're going to need silver. And China controls the spigot. This isn't just economics, this is geopolitical chess. And the first major move they made was on January 1st, 2026. Here's where things get serious. On January 1st, China rolled out new export licensing requirements for refined silver. Under the new rules, only 44 companies are now authorized to export silver out of China. 44 companies. In a country that controls 60 to 70% of global refined silver supply. Think about what that means. If you're a Western refinery, a bullion dealer, a manufacturer, or an investor trying to source physical silver, you now have to go through one of these 44 gatekeepers. And if China decides to slow walk approvals, tighten quotas, or simply shut off the tap entirely, there's almost nothing the West can do about it. This is supply restriction at the sovereign level. It's not a market decision, it's a strategic one. And the immediate impact was felt within days. Premiums on physical silver in Western markets started climbing. Delivery times stretched out. The flow of metal from east to west slowed to a trickle. China was sending a message: we control the physical metal, and if you want access, you'll play by our rules. But they didn't stop there. In the last 48 hours before the Chinese New Year shutdown, China escalated even further. The Shanghai Futures Exchange, China's primary silver trading platform, announced a sudden clampdown on hedging. Specifically, they reduced hedging quotas to 0. That means unless you have special approval, you can no longer open new long or short hedge positions on the exchange. Now, on the surface, this might sound like a routine regulatory move, but dig deeper and the implications are massive. Who benefits from shorting silver on the Shanghai Exchange? Foreign players, specifically Western banks who want to suppress the price globally. By blocking new short positions, China is effectively locking out foreign manipulation attempts on their home turf. And it gets better. Chinese regulators publicly announced that they've caught 9 suspicious short sellers, allegedly manipulating the silver price on the Shanghai Exchange. Some of these entities are reportedly linked to a major U.S. bank. Let that sink in. China just publicly accused U.S. financial institutions of trying to manipulate silver prices on Chinese soil, and then shut the door in their face. This isn't subtle. This is a direct counterstrike. China is saying, you want to play games with silver? Fine, but not on our exchange, not anymore. And the timing of this move, right before their 9-day market closure, is no accident. Starting this Sunday, Chinese markets shut down for Chinese New Year. 9 consecutive days where the Shanghai Futures Exchange goes dark. No trading, no price discovery. No ability for Chinese institutions to respond to market moves in real time. For COMEX and the US banks, this is the perfect window. Normally, if COMEX tries to hammer silver prices lower with massive short selling, Shanghai can counter by buying physical, bidding up prices, or simply refusing to follow COMEX's lead. The two markets act as checks and balances on each other. But for 9 days, that check disappears. China becomes blind. They can't react. They can't defend. They can't counter-trade. And COMEX knows it. So here's the likely playbook. During the Chinese blackout, COMEX floods the market with paper short contracts. They drive the price down aggressively, maybe 5, 10, even 15%. Retail traders panic. Stop losses trigger. We can sell. And by the time China comes back online on the 10th day, the damage is done. It's a classic ambush strategy. Hit your opponent when they can't hit back. But here's the problem. China saw this coming. That's why they tightened export restrictions. That's why they blocked foreign shorts on Shanghai. That's why they've been stockpiling physical metal for months. They've set a trap of their own. And if COMEX overplays their hand during this window, they might walk straight into it. Let's talk about the elephant in the room. COMEX's inventory crisis. Right now, COMEX has roughly 100 million ounces of registered silver. That's the metal that's officially available for delivery to futures contract holders. But here's the problem. There are 400 million ounces worth of open paper contracts on COMEX. 400 million ounces of promises to deliver silver. Do the math, that's a 4-to-1 ratio. 4 times more claims on silver than actual metal in the vault. Now, under normal circumstances, this isn't a problem. Most futures contracts get rolled over or cash settled. Very few traders actually demand physical delivery. But January 2026 was not normal. In January alone, COMEX delivered approximately 50 million ounces of silver. For context, a typical month sees around 7 million ounces delivered. January was 7 times the normal volume. That's a massive red flag. Now, it signals that people don't trust the paper anymore. They want the metal. They want out of the casino and into physical reality. And when delivery demand surges like this, it drains the registered inventory, which means the 4-to-1 ratio starts getting worse, which means COMEX is 1 bad month away from running out of deliverable metal entirely. And that's when things get really interesting. Because if COMEX can't deliver, the entire futures market, the primary price-setting mechanism for silver, loses credibility. Prices decouple. Premiums explode, and the paper game collapses. But it gets worse. The banks are starting to show stress. Silver leasing rates, essentially the cost to borrow silver, have spiked to 8%. That's abnormally high. In a healthy market, leasing rates are low because there's plenty of metal available to lend. 8% signals desperation. It signals shortage. It signals that someone, somewhere, is scrambling to find physical silver to meet obligations. Eligible inventory, silver held in COMEX vaults, but not registered for delivery, is also draining. And margin requirements have been hiked repeatedly over the past few weeks, forcing leveraged traders to liquidate positions or put up more cash. All of these moves scream one thing. COMEX is under pressure, and they're running out of options. Here's another massive tell. The price spread between Shanghai and COMEX. Right now, silver on the Shanghai Futures Exchange is trading roughly $20 per ounce higher than COMEX silver. $20. In a functioning, efficient market, that spread shouldn't exist. Arbitrage traders would immediately buy on COMEX, ship the metal to China, sell on Shanghai, and pocket the difference. That arbitrage activity would close the gap within days. But the gap isn't closing. In fact, it's widening. Why? Because you can't easily move silver from west to east anymore. China's export restrictions, shipping delays, and regulatory barriers have created a physical wall between the two markets. This is what decoupling looks like. Two major silver markets, both supposedly pricing the same commodity, trading at vastly different levels because the physical metal can't flow freely between them. And that $20 spread is telling you something critical. China values silver much more highly than the West does right now. They're willing to pay a massive premium to secure physical metal on their home turf. Meanwhile, COMEX is suppressing the price with paper contracts, trying to keep the illusion of abundant supply alive. But illusions don't last forever. And the spread is proof that reality is starting to break through. Now we arrive at the date that could change everything. February 27, 2026. That's first notice day for March silver futures contracts on COMEX. It's the day when contract holders must declare whether they're taking physical delivery or rolling their positions forward into a later contract month. This is the moment of truth. If a significant number of traders demand delivery, say another 50 million ounces or more, COMEX's registered inventory could be wiped out entirely. They'd have less than 50 million ounces left in the vault. And that would trigger a cascade of consequences. Emergency borrowing, defaults, forced cash settlements, price explosions, and potentially the complete breakdown of trust in the futures market. On the other hand, if most traders roll over their contracts without demanding metal, COMEX survives another month. The banks get a reprieve. The can gets kicked down the road. But here's the thing. After what happened in January, after the export restrictions, after the Shanghai crackdown, after the 9-day blackout window, sentiment has shifted. More and more traders are waking up to the fact that paper silver and physical silver are not the same thing. And once that realization spreads, the demand for physical delivery accelerates. It becomes a self-reinforcing cycle. The more people demand metal, the less metal is available, the higher premiums climb, the more people panic and demand metal. February 27 is the pressure point. It's the day when COMEX finds out whether they can keep the paper game going or whether the dam finally breaks. So what happens next? There are two primary scenarios, and both are explosive. Scenario A, the banks crush the price. During the 9-day Chinese blackout, COMEX unleashes a massive short attack. They flood the market with paper contracts, drive the price down 20, 30, maybe even 40%. Retail traders capitulate, mining stocks collapse, physical premiums spike, but the paper price craters. By the time China comes back online, the damage is done. The banks have shaken out weak hands, reduced their short exposure, and bought themselves time. COMEX survives February 27 because enough traders panic sold and didn't demand delivery. In this scenario, silver gets absolutely hammered in the short term. But the physical market decouples even further. Premiums explode. Shanghai and COMEX drift further apart. And the next crisis becomes inevitable, just delayed. Scenario B, China squeezes supply. Alternatively, China's countermeasures hold. The export restrictions strangle Western supply. Physical demand stays strong despite the paper price attack. And when February 27 arrives, delivery demand is overwhelming. COMEX can't meet the obligations. Defaults begin, cash settlements are forced, trust evaporates. The paper market implodes, and the price of physical silver rockets higher as the true shortage is exposed. In this scenario, silver explodes upward. Mining stocks go parabolic. Premiums go to the moon. And COMEX's credibility is destroyed. Both outcomes are violent. Both create massive opportunity and massive risk. And both hinge on what happens in the next few weeks. So here's where we are. China has locked down exports. They've blocked foreign shorts on Shanghai. They've caught manipulators red-handed. They've set the stage for a potential supply squeeze. COMEX is sitting on a 4-to-1 paper-to-metal ratio. Inventory is draining. Leasing costs are spiking. And they have a 9-day window to make their move while China is blind. February 27 is the flashpoint. The question isn't whether something big is coming. The question is which side wins. And the answer to that question will determine whether silver crashes to $20 or explodes to $60. So what's your move? Are you positioned for the squeeze? Are you hedged for the crash? Or are you just watching from the sidelines, hoping you'll figure it out in time? Because one thing is certain. By the time the answer is obvious, it'll be too late to act. Drop a comment below. Tell me what you think happens on February 27. Tell me if you're buying, selling, or holding. And tell me if you think COMEX survives this, or if the paper game finally ends. Let's talk. Because this is history happening in real time. And you're either going to be part of it, or you're going to be the person asking what happened after it's already over. I'll see you in the next one.